if you look at this last week's commitment of traders report, what you would see is somewhere in the neighborhood of 80,000 COMEX contracts were sold short. That's over 400 million ounces. And this short position that you speak of, which is spot on, was built somewhere in the neighborhood of $37.50. And with silver roughly up $1 right now from that point, these banks are trapped and bleeding, and they're down over $400 million just in a week, just on the movement of silver. But it's deeper in that. You have a guy, his name is Daniel Gali, I believe, and he's the head of one of the head guys at TD Securities. And he's all over the place with his thoughts. But he's arguing that the free flow, as it's called, the float, the number of bars that are available to be delivered off of the contracts that are issued in London, is at its lowest level in the history of the LBMA, which is a 140-year-old exchange. There's about 155 million ounces there, he says. That's less than 1 day's worth of trading in London. And at the same time, so you're seeing massive deliveries coming out of London. And as I've mentioned on your show before, London is a T+1 delivery. They're now saying it's T+8 weeks, 4 to 8 weeks, because T+1 means trade day plus 1 to settle. The third day, the bar should be moving to you. Well, we don't have enough in the way of manpower and trucks, says the Bank of England. So they've been caught, seems like. And so as a result, the borrowing rates in London are as high as 8%. I don't know that I've ever seen that. The lease rates, you need to pay 8% for a 1 month lease rate for silver. Wow. If you are trying to cover a position. Yeah, I've never seen it that high. And then, look, it's up 33% this year. It's doing pretty darn well. But, when you talk about things that would support your statement, there's something called an exchange for physical product, where a company or a bank or a hedge fund who has a COMEX contract can exchange it for physical, or the vice versa. And in 2 days this week, it's gone up about 240%. The cost has. So when you see the exchange for physical price go, and you can do that without going through the COMEX settling process. I have a contract, you have bars, we can exchange them. But that cost has gone up 240% in 2 days this week. And that massive increase signals massive stress in the silver market. And it kind of means that the traders are scrambling to find physical silver, which is in short supply. This isn't a small move. This is a major move, and it reflects tight physical markets, lack of trust in the pricing or in the market itself. So yeah, you're right. Someone is dumping. That someone are commercial banks who are trying to keep it from busting through, but they're being challenged for the first time ever by very, very sophisticated traders, sovereign wealth funds largely, and even sovereign wealth funds masquerading, or central banks masquerading as sovereign wealth funds. Very, very wealthy, successful, sophisticated, informed traders are standing for delivery off of all of the exchanges in London, the United States, and even in Shanghai. So yes, it's a desperate attempt to keep the price down. But in years past, if you would have seen that the commercial banks hold the largest short position they've ever had, ever, in silver right now. That's who's doing it. And to see the price react the way it was down this morning 50, 60 cents, and well, now it's up 25 cents. That's action we never have seen before. Never. Where, okay, we're going to knock the hell out of it as it comes into New York, and guess what? There's so much physical demand that it's up 25 cents. And so the price right now, let me get an accurate price right now real quick just to make my point. So if the position was put on at 37.50 and silver's at 38.31, you're talking roughly about $320 or $30 million down. The banks are in just a few days on that position. That's not chump change. And I wouldn't want to be that exposed over the weekend if I were them. So maybe some of that move up today where some of these banks trying to cover that position. But all I can tell you is that's as silly and stupid as a mud wall, because the demand for silver is outrageous at those levels. And from a technical standpoint, It's right at the top of the cup and handle formation that's 45 years old. It's the longest cup and handle formation which I've ever seen, which in technical analysis is as bullish as it gets. You combine that with spiking lease rates, you combine that with massive spiking costs in exchange for physical, massive delivery delays coming out of the exchanges because they're trading more silver than they have available and they're getting called on delivery. Yeah, it just seems that things are really changing and we're getting really, really close to the same breakout that gold had a year ago or several months ago. But typically silver slingshots and gold goes first, silver goes much further and faster on a percentage basis. So to a double. And the funny thing is, if you took the price of gold right now of 33.50, almost just under, let's just use that as the price, 33.50 divided by, even if we say 50, which is just above its 200-year average, that's $67 an ounce. At $67 an ounce, that would represent the 200-year average right now in ratio between silver and gold. So I would say to you that the chances are that, 67 would be the average price of 200 years. It's coming out of the ground at 7-1. So yes, the potential for it to go well through 50. And not only that, if you look at, and if you look at where the resistance is from here to 50, there's a little bit at like 41 and a little bit at 42.50. That resistance between the 1980 and the 2011 peaks that both touched right at or around 50, cumulatively in time, it hit those levels for maybe a few days max. That's nothing in the way of substantial resistance. And once it gets above those, there's nothing between it and 50. If it gets through 50, it's the same thing of gold breaking through 1900 or 2000, which was its previous all-time high. And then bang, it goes all the way up to 3,500. It's come back a little bit to 33.50. But the point of it is that, that was a massive move in a very short period of time once it got through resistance. And silver has been struggling for a long time to get through 31 and 32, and then bang, it got through it. And you saw how fast it jumped up, and now it's hit some more resistance. My guess is, based upon all of the metrics that we're talking about, they're trying hard to defend it here, to not let it get up to 39 again. If it does and gets through 40, all bets are off. The sky's the limit, really. I would say there are very few assets on the planet that have the asymmetrical pattern that silver does, low downside, high upside, and commercial banks that are trying real hard to keep it from going there as the rest of the world stands for delivery. Very dangerous setup for these banks. In fact, I don't know how any of the traders sleep at night going to sleep on a Friday. We'll see what happens tomorrow. If I had to guess, it would be up tomorrow.
And over the weekend is when a lot of things will happen. So what do you think of the sovereign wealth funds? You made a comment that the sovereign wealth funds are forcing some of their hands. What do you mean? Have they been accumulating gold and silver for so many years now that they're just going to force the price up? Is that what you're thinking is happening?
Well, I think they realize what the West is doing by holding down the paper price. And because the West is holding down the paper price, they stand for delivery. These funds that are based, these maybe Saudi. Yeah, well, that's exactly. It's a race for commodities. And what's really interesting about all of that is that there was I guess you could say, a survey that just came out, and the survey was of World Gold Council survey. They surveyed 36 central banks. 19 out of the 36 central banks said they are now sourcing gold and silver directly from small-scale or artisanal domestic producers. And an additional 4 banks said they're actively considering this approach. This is very unusual. In other words, I've been talking about how China's been going to Mexico and Peru and much of the global south buying gold and silver directly from the miners. But now you're talking a good number of central banks are doing this, which disintermediates the price. So they may be involved, as I believe they are, in suppressing the Western price. And then they go all around the world and they buy it everywhere, including doré bars and concentrate right from the miners, which are, the doré bars are crudely refined bars before they are full pure purified, and then the concentrate's a byproduct of all this. They pay double what the West will. They ship it to China and they refine it. They're the second largest producer
So
of
let's
silver in the world
explain
and the
this.
largest producer of gold. It doesn't affect the price.
That's what I'm saying. Yeah, it doesn't. But they're doing
or how
good.
much they're accumulating, so no one knows.
Operating
It's a
on
commodity war.